Right, week 3 guys, what we're going to be doing is order flow. Now, order flow is perhaps the most crucial part of trading because without order flow, you have nothing else. You don't get a chart, you don't get a profile, you don't get a footprint without order flow because without that, prices don't move. And this is crucial. Order flow ultimately dictates everything. It's participation, it's people enacting their opinions, putting their trades on, which creates the order flow. You putting a trade on contributes to that. You help a market move up or move down by putting your trade on. So you influence how a market moves. It may only be a one lot. You may not see the direct influence of your trade. You don't sell and price goes down as you sell necessarily, but you're contributing to that movement. And that's where the value of order flow comes, because if you're expecting something to happen, you're looking for something to happen, technical breakout, a reversal, whatever it is, unless you start to see other traders transacting in a similar way, it's not going to happen. You need to see the action follow the idea. And without order flow, you can't see that. All you can see is the idea either work or not, which is what you get from a chart. So what I'm going to do, introduction-wise, I'm going to introduce a bit of the terminology, a bit of a way of trying to categorize and consider what you're seeing from an order flow perspective. Perhaps the hardest thing with order flow compared to any other technical analysis is that order flow is much less easy to document. You look for a chart, you can go and find examples on a chart of a head and shoulders pattern, and you can scroll back through old charts and you'll find them. But with order flow, you're not able to do that without going back and re-watching a recording of every single day. And that's the bit that's hard to do. So it's your way of describing order flow that is key. You have to have an understanding of what you mean by it. Now, I'm going to give you some of my version of how I explain it, of what I sort of term different types of action as. But bring in your own versions. Nothing helps you remember something better than having your own way of describing a piece of action. I'll give you an example when we look at spoofing, market manipulation, a way of me describing it, what I've always called it historically, compared to the way Alex describes it. And ultimately, we both know exactly what we mean and we both come to the same conclusions, but we have a different way of describing what we're seeing. So that's important. Keep that in mind for this week, that whatever you see, if you can have a consistent way of describing that to yourself and a consistent understanding of what you mean by the way you describe something, this is massively beneficial. So, without further ado, try and break this down and understand, illustrate why it's important and then the bits of info that you're looking and needing to understand. What you typically get then, before anyone gets down to order flow, is most people start with a chart. Now, order flow ultimately builds on the levels of information that you get. A chart's the most basic information. You get price information. This tells you where the market has been, but it doesn't tell you what's happened in getting there. It just shows you that the market's gone up, it's gone down, it's gone up, it's gone down. But you don't know whether there's been a lot of buying gone up moves, a lot of selling gone down moves. You don't know what happens at the turning points. So all you get is essentially a list of prices that have traded. And that's fine, that's useful information because that develops patterns. Then you add on to that volume. This gives you a little bit more clarity because it shows you how much is going on. Are people actually participating in these movements? But even so, you still don't get a sense as to how exactly they're participating. All you're getting is the number of trades that have happened. You don't see, when you see volume increase on a single candle, you don't see whether all of that volume has been done at the low of the candle, at the high of the candle, evenly distributed across the candle. And you don't also see how exactly that volume was done. That's what Delta brings in. We talked about this in the first week. Delta and a footprint will show a similar type idea as well. They will show the aggression of orders, and that's really valuable. So you're now starting to get a little bit more information here, because what you're then seeing using Delta and using footprint is you're getting to see who's taking the action. Is it a case that somebody's essentially saying, I'm willing to sell here, and a buyer says, okay, I'm willing to pay that price? That's a more aggressive action because you are acting and saying you are willing to meet their offer. Likewise, for price to move down, if you're going to see a strong selling move, you want to see sellers go and meet the bid, i.e. they will say, I am willing to sell at a lower price. Of course, you want to sell at a highest possible price. But when there is a necessity to sell, you are then willing to say, okay, I will sell it to you at that lower price, to the person saying, this is the price I want to pay. Are you willing to sell it to me? And then you will get that move down. So Delta and footprint give you a lot of information because they show you the aggression of the buyers and sellers. What they don't tell you is the full story though. Because the full story comes from the interaction between those buyers and sellers, between the people sitting there resting their offers waiting to be filled and those who are actually coming to buy from them. And the difference is here that what order flow shows you is it shows you that battle. Take, for example, a situation where you have a really, really high positive delta. This could show that there is a lot of buying going on. But what you may not see is that this buying is buying into a gigantic sell order. In which case, this buying is not as strong as if the buying was driving through sell orders. So there's a different story, and you only see that when you see both sides of the coin. This is what a price ladder does for you, because it shows you not just the passive orders, which you don't see looking at cumulative delta or footprint, and it then shows you the active orders, the last traded quantity. I'll talk through these in a moment. It shows you that, which then shows you how these orders are being executed, how the market is moving. So it gives you so much more depth of understanding, essentially, that you can see how reference points have created. If a market has gone down in this instance and bounced back, what exactly happened here? You get to see that. You get to see whether it was a slowing down of sellers, whether it was that sellers could not get through a very large order. Perhaps this, what is now showing 745 lots on the bid, perhaps that was 1745. 1,000 lots get sold and the market doesn't find enough sellers to keep selling, and then the bounce back comes. That could be what's going on. So you get to see exactly the story of what's happened in detail as it happens. And this then shows you how aggressive orders are being met. Are they getting people to get out of their way? You know, somebody comes in and buys and they say, yeah, I'll buy, and then they buy the next price. Do you then start seeing these passive orders disappearing, or do they keep on coming back? In which case you're going to run out of buyers. And on top of all of this, and this is the bit that you really don't see from anything else, is you see the speed. You can see that changing pace of flow, those changing orders going through and the way that they change. That is crucial, because that gives you that sense of sort of urgency, necessity to do something. That gets everybody moving, and that's what then drives the market. Key thing to remember, everything is a derivative of order flow. Any chart that you see, no matter whether it's candlesticks, volumes, delta, profiles, footprints, whatever it is a derivative of order flow. The order flow creates it, and equally the order flow will dictate whether any expected action from a chart is actually going to play out. And ultimately, anything else really just shows you the cumulative view of all the other participants within the market. Right then, so you've got a sense as to why this is so important. What we're going to have a look at now then is what exactly you're seeing when you're looking at a ladder and how to interpret this information. Because without that, it is essentially a ton of numbers flashing up and down, constant action, and this can create an element of confusion. It creates an element of overload of information, which is hard to then decipher, pick through what's really important, and also act on that. So what are we seeing then? Perhaps the most crucial bit is the last traded quantity, but I'm not going to talk about that first. That is your last traded quantity, in this instance 440 lots. What we're going to look at to start with is the bids and offers. So with any price ladder, and I showed you how to set these up in the first week, with any price ladder, I would suggest you can keep this very simple. You have your bids, the price, your offers. Nice and easy. Now, what you're looking at with your bids and offers is there's a few different pieces of information you're going to gain. You want to be looking at the size of them. That's the obvious way of interpreting whether a market is strong or weak. If you have more bids, then this implies a stronger market, that there are more people willing to buy. But that in itself isn't necessarily enough, because chances are, as a market falls, you will increase the number of bids. People are happy to accept a bargain. As the market rises, chances are the number of bids will fall. It will reduce down if people are less willing to pay such high prices. So it's not necessarily always the greatest of indications, because more bids is not necessarily indicating a stronger market. It may actually be showing that a market is weak and is now finding more people willing to pick up a bargain. Whereas when a market is strong, you will run out of buyers, because naturally, as a market moves up, you get less buyers because they've already bought. People are less inclined to pay such high prices. But what you're trying to look at and interpret in the immediate term, so just looking, when you're looking at a price ladder, predominantly your eye should be focused on this area here. Perhaps the best two bids, the best two offers, and the last traded quantity. All of the rest of this is more a peripheral thing. So you can see generally whether you've got more bids or offers. But what you're really trying to pick up on is how these react when people come and sell to them, or how they react when people come and buy from them. That tells you much more story, because that tells you whether there's somebody willing to keep on selling or whether people are willing to get out of the way. So are they changing, for example? So take, for example, you see here, somebody's bought 440 contracts. That may be a combination of people, doesn't matter how it's been bought, but 440 has been bought. The number of contracts on the offer has reduced. Okay, so that's reasonably fair that you've got 123 now on the offer. If you add the 440 back to it, you get 573. Looks similar to what everything else is. Okay, so that is fine. But what would then be interesting to see, and this is where the just bids and offers tell you a story. If on the back of seeing this, all of a sudden, this offer and this offer suddenly get smaller, what this is showing you is that on the back of the buying of 440 contracts, other people are now thinking, I'm not going to sell this price because somebody's willing to buy. I don't want to sell now. And they may well then move their orders higher up because they think, actually, I don't need to sell it down here. I can sell it up here and get a much better price. So then the offer side thins out. People wanting to sell suddenly step back. And this now gives the opportunity of movement. So it's that interpretation of not just simply whether somebody's bought or sold, which is what you get from a delta or footprint, but how everybody else reacts to that new incoming information. Remember, every single trade is new information. The other thing that you get a good clue from resting orders is whether they start to move. If you've got a very stagnant market, orders not really changing, you might see maybe a bid might grow by 5 lots, it might shrink by 10 lots. That's not very significant relative to the size of orders in this market here. Where it becomes significant is where you suddenly start to see a change in the orders. They start to change more quickly. And you can see this just peripherally, that you're watching the other orders in the book and you start to see them all beginning to change. This shows a degree of urgency, a willingness to start to transact, a willingness to do something. Think of it like a large crowd of people. If everyone stands still, nothing really happens. But you only need a little bit of movement for a few people in a large crowd to create a bit more movement and a bit more movement and a bit more movement. And all of a sudden, the market's now ready to move. The crowd's ready to disperse. It's that same kind of idea. So that's what your bids and your offers are telling you about. So next up, you want to be considering the last traded quantity. This ultimately is what drives the action. And there's a few things you want to consider. So we'll tackle these in order. The size of the last traded quantity relative to the bid and offer. Take this example again here, 440, that will have just eaten into the offer. Assuming that offer was reasonably similar to everything else, it has taken a very significant chunk, about 80% of everything that's on the offer there. That's quite significant. So that size of the last traded quantity relative to the size of the offer or bid that it is traded into tells you about the willingness of people to act. If this is a 4 lot, you'd look at that and think that really doesn't matter. Somebody's bought 4. Maybe that's because they were short and they needed to get out. Maybe that's because they just wanted to add 4 to their position and they didn't have the patience to wait and see if they can get filled on the bid. Whatever it is, that's not going to significantly move the market. It's contributing, but it's not going to do much. The other things you need to then consider is the frequency of transactions. Are you seeing orders going through quickly? And you're looking at the consistency of this. Are you seeing them hit once, nothing happens? Then once again, then nothing happens, then once again. Or is it hit, 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 hit? You're not trying to quantify precisely the speed. Humans are very good at recognizing differences in things. So you don't need to quantify the speed exactly, and speed meters and all of those things I don't really think actually serve that purpose. You can see it, you can tell, trust yourself. In any other walk of life, you'd be able to do this. If you're driving down a road, you can see a car accelerating. You don't need to know how fast the car is going, but you can tell that it is getting faster. And it's the same principle here. You can see the orders going through, you can get a rough idea of the pace of the orders going through, and you can tell if they're going through faster. That's enough. That's the information that you need. It's the change that you're after. You don't need to precisely quantify these types of things because it's all relative to what's currently going on. You then need to look at direction of transaction. How are the orders going through? Is it a case that you trade up 440 and the next trade is down and the next trade is up and the next trade is down and up? If that's the case, this is a market that, yes, is putting trade through, volume will be increasing, but it's not going anywhere. It doesn't have any clear direction. Whereas if it is more a case that you see 440 trade, this offer gets eaten up, a bid moves higher, and market now starts to trade here, and then a bid moves up, and it's very, very one directional. There's no trade up, trade down, trade up, trade down, trade up, trade down. It's trade up, trade up, trade up, trade up, down, up, 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 up. That way is showing you there's much more willingness of buyers, not just to buy. The pace of buying may not have changed, but the direction is there, and that's crucial. And the other thing on the back of that then is continuation of transactions. Are you still seeing orders going through time and time again? Is the pace of orders going through still retaining, or is that actually starting to decelerate? That way you give yourself a sense as to whether a move can actually keep on going or not, whether it is slowing up, running out of steam. So that gives you a sense of the transaction between the two. The more and more you watch it, and we're going to break this down into different sort of pieces of action, the more and more understanding you're going to gain of this. Final thing then, volume profile. You want to be looking at how volume has been created. So what I mean by this, and we've talked a lot about profile anyway, but in the very short term, you're looking at where the volume gets transacted. You see somewhere, for example, up here, you've got 1,300 lots in the middle of a number of few light orders. Anything above or below that is at least 600 contracts less than this order. So that stands out as a significant price, even though it's not massively significant compared to the volume done lower down here. It is showing you that action has happened. You can see then how that volume is done, what exactly has happened there. And that can also start to tell you a story about the ability of the market to continue or the ability of a market to reverse. It also gives you a sense as to what needs to happen for a continuation of movement. Take, for example, up here, you've got this very light volume. So at this point in time, you'd be thinking that's at least the limit of trade towards the upside. So you then can look at this from a volume profile perspective and ask yourself, well, what needs to change for this to go higher? One way the market could go higher and can show you that potential before you get it from a candlestick or before you even really see it on a profile is we could trade up here and then we start to put more volume in at this price in particular and the prices around it. This way, you shift volume higher. And as you do that, that allows for a continuation of movements. Always think about the potential of what could happen. What order flow would happen that could allow this market to continue onwards towards the upside. Next up then, auctioning activity. So this is trying to give a description of what's going on. So you can look at something and say, right, that looks like X and I'm expecting a certain type of auctioning activity. So let's go and touch on the first thing. For me, the most important thing that you're going to gain when you're looking at order flow, when you're looking at a price ladder, is a sense of velocity. Sometimes this will be interchange of energy, so the pace, that feel of action within a market. But velocity is a good way to describe this because this encompasses two things. It encompasses the speed of the orders going through, and also direction. That's the distinction between velocity and speed. That velocity has speed and direction. Speed is just orders going through. So you can have a low velocity market. The speed of orders going through may pick up, but direction is more limited. So you're looking at how quickly trades start to go through a market. The other sort of secondary piece of information on that is how quickly the passive orders are changing. So like I said, those bids and offers, if they're doing nothing, then this shows no urgency or willingness to act. Everybody is quite happy to sit there with the price that they want to trade at and wait for the market to move towards them. It's only when other people start to change and shift in the way that they're trading, shift their orders around, that this now brings in a necessity to do something. You feel that if you don't act now, you may not get the opportunity. And that then is what starts to drive velocity. It starts to drive this extra flow. So like I mentioned before, you're always looking at change. That's the key bit. So in terms of how you interpret velocity, the simple way that I would describe it is, and the main way that I'm looking at it, is looking at that last traded quantity. How quickly are the orders going through and are they all one directional? Is it majority buys? It's rare that you ever get a situation where everything is a buy or everything is a sell. It is more a case that the majority of orders are all going through as a buy or all going through as a sell. So how are we going to interpret this? Two situations. You have velocity increasing and the market not moving, so speed picking up but the market not directional, or you have movement, speed picking up and the market starting to move. And these have two distinct different pieces of information. If you have a lack of movement, so you go from a market that steadily is moving up and down to is now moving quicker up and down, this is showing energy. This is showing that it's getting itself geared up to move. So you can now be ready either direction for a breakout. Because as more and more orders are going through, this creates a sense of urgency. If you don't trade now, you may not be able to get filled. So as soon as the market starts to move away from that area where that velocity is picked up, now more and more people start to transact. If you have movement, then this maintains direction. Now I'll talk about this in a moment. I'll give you a kind of analogy to physics and the concept of how a distance changes with speed and also with acceleration. So I'll give you a little bit of a kind of sense of that in a moment. But the movement is maintained by bringing more people in. So go on that idea again, of it builds up sort of a desire or a need to do something. So as soon as you get velocity increasing, this creates an urgency to trade. As more people start to trade, more activity comes in, price starts to move. Because if I'm worried that I'm not going to be able to buy at the price available now, I might start to act quickly. In me doing that, I take away that price. Meaning that now somebody has to pay a higher price. But if they don't pay a higher price now, they may be paying a much higher price later. So this brings in more participants. And this now creates increased urgency. This moves price. This is what we call price discovery. That's how it happens. That somebody thinks, I better buy it now. They buy, they take away some of those available contracts. This makes other people buy. And other people buy because everyone feels that if they don't do it now, they're not going to get their trade on. This increases participation. This is why volume goes up as the market starts to move faster and more directionally, which then further increases velocity and it cycles round. And as long as that continues, a market will continue to drive up, down, whichever way it's going. You will then need to be looking at relative acceleration or deceleration. Because this is where moves change. And there's two ways that a move can come to an end. Either you get an exhaustion of action or you get a deceleration of action. So it's so crucial where these things happen. That's the important bit. Acceleration within a move, at the beginning of a move, so out of an area that's previously been traded, is great. This is what you want because this shows people are now starting to drive the move on. Acceleration after a move has happened, so a market that has gone up and up and up and up and then starts to accelerate, is more of an indication of an exhaustion. People are running out of willingness to wait and they are willing to all chase the market at once. Two different pieces of information here. Acceleration away from currently traded prices is a sign of change. Acceleration on the back of an already fast move is a sign of exhaustion. You can't maintain that pace forever. From a deceleration perspective, what you're looking for, orders go through slower. Now, this again has two different interpretations. If orders are going through slower, this leads the market to stall. It slows down because people aren't coming in to drive it. The urgency is no longer there. But this does not necessarily mean that the move is over. What it means is you're now in a decision point, a point where we have to work out, is this a market that is about to put in another leg? So stalls, and then you get the same process of velocity start to pick up in the range. This increases the energy. This then drives the market higher. Or is it stall, you're running out of buyers, and then you start to see the number of sellers increasing, and that velocity then starts to go the other way, and the market turns back on itself. So that's the way that you want to be trying to interpret the velocity to start with, and then also the relative acceleration, deceleration. So much of that is contingent on where exactly it's happening. That's the key bit. You need to be able to interpret what has preceded that bit of action. All this becomes more clear once you start to see these things actually happening. Okay, come back after the click. Right then, other piece of information you get from auctioning activity. Volume. This isn't total volume, histograms on a chart. This is the size of the orders getting traded. Larger orders being traded creates more movement. So it's all about relative to passive orders. Again, this is not an absolute number. This is looking at something and saying that is big compared to what you've previously seen. In the same way that if you're walking down the street, you don't need to know how tall somebody is to be able to say that person is tall relative to other people, or that person is short relative to other people. You don't need precision, you don't need a tape measure to be able to know that information. That's what you got to consider. So, what you can have is a situation where larger orders going through are also a sign of direction, even if they're not necessarily going through any quicker. But if you start to see bigger and bigger orders hitting compared to what you have been seeing, this is a sign of people starting to act. And that is often then a prelude to the beginning of a velocity increase, to a market getting quicker and starting to become more directional. The other thing to be aware of here is low liquidity environments. When markets get less liquidity, and the way I'm going to describe liquidity is the size of the orders, the size of the passive orders, bids and offers. If they start to get thinner compared to what is typical, then this creates more volume. It creates less volume at price, because if you normally are able to buy 200 and now you're only able to buy 20, you can only buy 20. So volume at price decreases. But because there are less orders at any single price, the market will move faster through those orders in order to get the same volume done. This creates and naturally leads to more and more urgency to trade, because prices move away from you quicker. And so often then lower liquidity, in fact, will increase velocity and it will increase volume, because people need to become more active now rather than just passively waiting in a high liquidity environment. So bear that in mind, but a lot of it is to do with, and it's still always to do with the size of the order relative to what is there on the bid or on the offer. And you're looking for that clue. Equally, you can have a market that moves very steadily and it ticks up and up and up and up. It doesn't really change the speed with which orders are going through. Directionally it's there, but it's the volume of those orders going through. As long as the larger size is getting hit, this is also going to be able to sustain movement. And the last thing then is the direction of the activity. This is about looking at the comparative size traded into the bid, into the offer, into the bid, into the offer. You can see this to a degree with a footprint. And certainly you can see that at any two prices with a footprint. What you're looking at then from a ladder is to see the sort of cycle of this over a rotation of a number of prices. So it's all about asking yourself, is the direction being sustained? Are you in a situation where, and to use this little example here, that you see situations where once selling comes in, that direction is sustained. You get continued selling activity here. The market may well then slow down. And what will happen is you'll get this sell, 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 buy, sell, sell, buy, buy, sell, sell, buy, 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 sell, buy, sell, buy, sell, buy, sell, and then the market can start to rotate back up. So you have a situation within this move where the selling direction changes, that you start to see more people willing to hit into the offer as much as they are willing to hit into the bid. This then allows for a small bounce. But the other way of looking at this, so that was kind of to describe this bit of the move, but this can be entirely, this move could be described within all of this, that you will see these short-term changes. And what other way to try and consider this is to look at rotations, particularly in thinner markets and faster markets. You're less looking at the individual tick between prices. You're more looking at the relative size of the rotations. If consistently the bounces are reasonably the same, then this is showing the market rotates back up and then it runs out of that direction. Once that changes, and now you don't see this sort of reasonably even rotation, perhaps let's call that 12 ticks down, 5 ticks up, 12 ticks down, 5 ticks up. It now does 12 ticks down, 5 up, 7 down, 6 up, 7 down, 8 up. You now start to see a completely different type of rotation. Once this evens out, this is giving you that same kind of view. The market is no longer able to maintain that direction of orders. It's much more a case of it is starting to become more fluctuated, and that then is another indication of that direction of activity shifting between the two. So a lot to take in there, but you need to be thinking about the speed with which the orders are going through. always ask yourself, is this different to what we have been seeing? Because it's those changes that alert you to something. Are you starting to see larger size of orders going through compared to what you were seeing perhaps 5 minutes ago, 10 minutes ago? And also, how is direction? Is it still for every buy there's a sell, every buy there's a sell? Or is it now that you get 5 buys for every sell, and those buys are 5 times the size? You know, if every buy is a 50 lot and every sell is a 10 lot, that's telling you something to start with. But if now you see 5 50 lots buy and 1 10 lot sell, that's showing you that buyers are very, very much in control. So next up, we're going to go and have a look at this as a kind of comparison to physics. So from a physics perspective, what I'm trying to illustrate is how the action occurs. So if you look at distance as where the market goes, so view this as a sort of line chart of what happens over a period of a number of seconds, a number of minutes, it doesn't matter. I've used a kind of description of physics here to try and explain this. Now, what you will have, and imagine this is a market that's sitting reasonably stable, as direction changes, this is where you get the greatest amount of acceleration. You see then movement. This is what starts the move off. So this is the one directional, bang, 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 people buying into the offer. And this tries to illustrate the distinction between where you are and what's happening. Because once this has started, once you get that first acceleration, you don't necessarily get more acceleration. But because this has sent the direction one way, you then get this inertial movement whereby velocity stays the same and is high. Acceleration falls back to zero. You're not accelerating, but velocity is staying up. The buying is still directionally up, and the pace of that buying is now maintained at the pace achieved at point 1. This continues the market's movement up then. And the only way this is going to change is when the market decelerates. Essentially, the brakes get put on. Now, this happens in one of 2 ways. You run out of buyers, or that pace of buying starts to reduce, and also you start to see larger offers, more selling, so directionally you start to see more people hitting into the bids as well. This reduces velocity, and that's all to do with the fact that the market is now accelerating the number of sellers. More and more people are coming in to sell, but the action that this causes, as selling increases, to start with, all it serves the point of doing is slowing you down. It doesn't reverse you, it slows the market down. It's only once this now actually starts to completely slow the buying down and then it starts to become the dominant force. Sellers are now more prevalent than buyers. And this has been going on from here, but buyers are still sort of countering the selling. Buyers keep coming in. So now the same pace of selling is now actually completely stopping the market, and in order for people to continue to sell, they now need to sell at lower prices because there aren't any buyers maintaining the move up. So they now come in and sell at lower prices, and this is what creates the turn. The market starts to drop, that selling pace is maintained, that continues the movement towards the downside in 0.5, and the sellers continue to maintain control until, again, you see the flip back, and you may then see a punch of buying as you reach this point here. Remember, markets aren't, like anything else, going to stop and just instantly turn around. That will take a huge amount of energy because it's not about stopping and turning. It's that you've got to find enough sellers to overwhelm all the buyers who are clearly happy to come and pay higher and higher prices. Got to stop all of them and start to sell. And to do that in one moment is extremely difficult because the volume of selling that would have to come in to do that has got to be immense. It's got to completely overwhelm everything that is already there. And that's why, in reality, every market will, even if it seems extremely quick to do it, will slow down the pace of buying, and then the selling pace will increase. As that selling pace increases, firstly, it slows down the ability of the market to go up, and then it gives the ability of the market to roll back towards the downside. So there you go. If you like a bit of physics and you're trying to think about, as I talked about with the ball rolling on a profile type idea, if you think about it from this perspective, you can now see how a market is going to turn and how you want to be looking at those pace of orders changing, which gives you that sense of acceleration, which is then what leads to the velocity, the direction and speed of movement. Next up, I want to give you a little bit of a generalized order flow. So generalized patterns of flow. And I've got a ladder up. This is just a ladder running at this point in time. So live prices as they're trading through. So we're not looking for anything specific here. Don't know what's going to happen at this point, but there are some generalized patterns of order flow that you can be looking for and a sequence of action Now, when I talk about a sequence of action, this doesn't have to happen over one price. It can happen over multiple prices. So you may see pace kind of move up and down and up and down and up and down. And that would be a similar, a situation where you're sort of seeing two-directional trade, but could well also give you an indication of the ability or where the action can change. Right, so quick summary or sort of cheat sheet of different sequences of action. If you're looking for a strong bid, what I would call a strong bid or the beginning of a momentum type move, what you're going to see is you're going to see lifting the offer. So what's going to happen there is somebody's going to come in and buy into the offer. You just see it there, 10 lots bought into the offer, but the offer doesn't go away. With a momentum type move, what you would see, we will trade into the offer, completely take the offer away, so eat up everything on the offer, and the bid will then move up. As that happens, people will then start to trade into the next offer. So very quickly, they will then go, right, trade, in this instance, trades into 93, bid will move up to 93, trade into 94, bid moves up to 94. That would be a sign of momentum. You're not seeing that here. Since we've just been watching, we've seen a couple of times it trades 93 and the offer comes back. This perhaps could be a better indication of absorption, that somebody comes in and lifts the offer, and then the offer returns. So after somebody comes and buys, say 93, that offer returns again, which is what we've kind of seen here. Then you get another attempt to lift the offer. People trade into the offer, and the offer returns. This is now a bearish signal, because what you're getting is you're getting a situation where, having tried to buy, people are willing to say, no, we're still willing to sell at this price. Another attempt comes and people are still willing to sell at that price. And you see that there to a degree. Again, 93, 94 continually coming back. And the offer returns again. Right, absorption then. What we're looking for here then is a situation where people will lift the offer, they buy into the offer. Take somewhere like 94, 93, which you've seen this a couple of times now. The offer returns. So when people buy into it, the offer comes back. It may not completely be eaten up anyway. So it might be, say, 100 that reduces to 50 and then goes back up to 100. This would be a sign of absorption. If people try and lift that offer again, so they buy into that price again, and then the offer returns again, this is really showing you a willingness of sellers to continually stand in the way at this point. This is what stalls a market. This is where velocity changes, because yes, you may still see people buying, but they're going nowhere with it now. This is the beginning of potentially a turn, because it stops the market. And of course, then you could have the sort of battle with the absorption. That's something we're going to cover in one of the future sessions. And we've seen that here. Each time we looked at 93 and 94, the offer kept coming back and it kept coming back and it kept coming back. There's your absorption, which then can lead to momentum to the other direction, which is what a reversal is. So what happens in a reversal, and this is always looking at examples where the market tries to go up. Of course, all of this works if you flip the ideas over, there's hit into the bid, etc., and you flip the idea over. But for a reversal, what happens, as we have seen, you lift the offer, market trades up, the offer returns. And very quickly now, you move away from the absorption where it's buy and the offer returns, buy and the offer returns. It's now a case of buy, offer comes back, sell. So people now take the initiative and sell into the bid. Whereas with an absorption, it's more a case of just standing there and letting people buy from you. Now the sellers take control. They come in, they sell into the bid. The offer falls down, and this is what we've just seen here. Absorption at 93, 94, then you get the reversal and you start seeing the sell, 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 sell. It's pushed us down towards 85, 84. You can now get a picking up of momentum. So you trade through 85, 84, 83. If we trade 83, then 82, then 81, this is where you can then see momentum picking up. Directionless markets, on the other hand, do not do that. A directionless market may have a situation where it lifts the offer, then it hits into the bid, then it lifts the offer, then it hits into the bid. And all of these things are fractal, because you could describe this as directionless. If this market continues to trade here, overall it's directionless. But for short periods within that, it is very clearly got elements of momentum, moving from 93 down to 82. It also has elements of reversal and absorption up here at 93, 94. We've not seen what happens yet down at 83, 84, 82. Oh, sorry, 84, 83, 82. And so therefore you're now waiting to find out, is this a situation where we see some absorption, where we now start to see that actually people start to lift the offer and push us away from this little zone here and move back up and back to this zone. So everything is fractal. Within each area, you can then see examples of momentum change. And this is what helps people differentiate between a scalping strategy, short-term little trades. You're starting to see that momentum increasing now. As I just mentioned, down there we stalled at 84, 83. Now you start to see 82 at trade, 81 trade, 80 trade. Offer keeps on dropping down, 80. You're now looking for it to sell. Will it sell into 79? Can it maintain that pace? Can it pick up that pace? That's what's going to give you a sense of direction. Now you start to see a little two-way transaction there, but it cannot trade 81. Now you see traded 80, 79, offered. Trades back bid 79. Can you trade now towards 78? But you start to see already, just since we've been looking, that in fact, what we've now seen is a market that has, I'm trying to draw this in very short term, we have traded, since being on this slide, we have traded 93, 94, we've traded down 83, 84, traded down towards 79, and we're currently trading back. This is where we currently are. Either now, we could be looking for this move back up if the sellers can't maintain the pressure now and can't hold the market down, or we see sellers now becoming more urgent and they drive the market again, and you're looking then for the next move down. For a rotational perspective, perhaps the next area to look for is down here at around 74, based on the sort of 10 ticks, up, down, stall, another 10 ticks. But of course, you're going to be looking at the order flow when you get there to see what happens. Do you see more absorption when you get down here? Do you see this momentum continue and the market accelerates? Selling becomes faster and faster and faster and faster and faster, in which case the market is then going to continue towards the downside. So that's how you've got to try and interpret it. And you're looking at these generalized patterns of the way the orders transact, the way the orders go through the market. That's what's going to give you a good sense of information, a good sense of what's coming next. You're actually seeing here now, looking at the passive orders, distinct slowing down of their movement. As very little trades, they all slow down. Market is very much now stabilized. We're waiting now for the next bit of information. And that could come quickly, it could come slowly. But as soon as you see a change in the pace, you start seeing these passive orders shifting around quicker, now you can start thinking something's going to happen. Action's going to come here. And at the minute, we're still sort of two directional around the 84 to 80 area. Right then, that's your generalized way of interpreting short-term action. What we're going to look at now then is environment. So when I talk about the market's environment, I'm talking about over the course of a day, over the course of a week, how is the market trading? Because this will also influence the order flow, the speed of which action is happening. So always think about this. I talked about the idea of looking at relative change in pace, relative change in velocity, relative change in volume. You also want to be looking at that not just over a very short-term basis, but also over a, say, daily or a weekly basis. Is today a day that is trading faster and faster and faster than previous days? Or is today a day that is trading much steadier, much slower? That's what you've got to try and work yourself out for. So you're building up this broader picture. So to give a couple of different sort of environmental generalizations, you have high volatility. What you're going to get in a high volatility environment is fast directional movement, so high velocity. It will also exhibit quick changes because the market is thinner, there's lower liquidity when high volatility is around. So the market will zip up. If it stalls and it doesn't keep on going to the upside, then sellers very quickly transact. Because if they don't transact quickly now, the market will move away. So it creates this constant urgency and constant sort of movement, switching of direction, larger movements generally as well. You're usually going to see less volume per trade, but you are going to see higher overall volume. More transactions go through because that urgency picks up, because people need to transact now, otherwise they'll miss their opportunity. And also because of the amount of movement, more people will transact because they can start to trade smaller ranges. They can start to take advantage of this volatility. This is what day traders love. This is everything that you want because it breeds opportunity. Low volatility environments do the opposite. You have much more non-directional trade, low velocity. Markets move slow. You feel like the action is turgid, like nothing is going on. You see more absorption in these environments. You see more flipping and market manipulation in these types of environments because people aren't feeling the necessity to trade. So therefore, manipulation can happen because you can push a few people to actually trade, which can create a situation where markets can be manipulated. You get generally high amounts of volume per trade. So where in a high volatility environment, you may see 50 lots trading. Low volatility environments, you might see 500 lots trading. Same market. But you get low overall volume. People are much more patient. There's no urgency to trade. There's no need to transact right now. So less people do. They wait, knowing that if this status quo lasts, they're going to be able to get their positions done and they don't need to do anything about that today and maybe they can trade it tomorrow. Now the movement between the two is crucial, and this is perhaps the bit that you really need to pick up on, is the less obvious. Rising volatility then. In a period of rising volatility, you will get sporadic bouts. You get this sort of jump in volatility all of a sudden. Markets do start to move quicker, but this can sort of drop off quite quickly. You want to see this sustained, but you will get these little spurts of velocity, direction, volume. What you're looking for here, and a good clue to this, is that if this creates a directional move down, for example, and then you see less volume on the way back, and then high volume again on a move down, and you see the pace on the moves down much, much quicker, this is a sign that volatility is picking up. It's going to entice trade. It's going to create a need to change perspective. Conversely, falling volatility, you increasingly see and feel market becoming lethargic. What you were seeing, what you were expecting to happen is no longer happening. And instead, you're just seeing this kind of steady action. The market doesn't really want to do anything. And that's the beginnings of a volatility compression. Markets become slower. Trades don't go through so quickly. Volumes start to fall. They fall per trade, they fall overall. This way, you now start to move into this low volatility environment. The action dissipates, markets then slow themselves down. So to give you a quick summary of order flow as an introduction, ultimately, you're looking at a balance between these two, a balance between absorption and reloading. And we're going to come on to these in the coming days, looking at what happens in an absorption, how people participate to try and disguise the orders that they're trading. We're going to look as well at how exactly you trade around this. Do you treat an absorption as an opportunity to join that absorption? Do you treat it as an opportunity to trade through that? And that's going to be dictated by the way the market's trading into the absorption. There's this constant balance, because the way an absorption gets broken is through higher momentum. The way an absorption holds the market is through lower momentum. So it's this constant battle between the two. More aggressive action, market forces its way higher, forces its way lower. This gives opportunity to play continuation and directional trades. But it's all about whether this is maintained. And this is what I mean, this constant battle between the two. Can a market maintain that high velocity, that directional movement, or not? What we're going to also look at during this week is specific order flow plays. So these are the kind of trades that you can almost treat as scalping opportunities. Trading large orders. How do you front run a large order, for example? What does a large order do dependent upon how it appears and how it shows itself in the market? We'll look at flipping, spoofing, so market manipulation. How do people do it? How do you recognize it? How can it impact your trading? How can you use it to make money? Not doing the flipping or the spoofing, not doing the illegal side of it, but by understanding the types of movement that it creates and how you can trade around that in a profitable way. We'll look at forced action as well. What happens and how can you expect a stop to go off? What does that cause in terms of market action? How can you trade around these? Can you take advantage of the stop being set off? Can you take advantage of the quick reversal that typically follows these? And the other thing that we'll look at is the flow going into specific events, particularly around month ends, around option expiries. What type of flow do you expect? What types of patterns occur? And there are very common patterns during month end, option expiries, bond auctions, similar as well. You get very distinct order flow patterns. These can be picked up on, meaning that you can trade a very distinct time of day. You know exactly what should happen at this moment. And if it does, you can trade it. If it doesn't, you can walk away and say, well, it's not going on today. I don't need to be part of it. But it allows you to direct your view of flow and manage your expectations of flow. Perhaps the one thing that you should always be thinking about, whether it's looking at a time-based pattern, whether it's looking at a technical pattern, whatever it is ask yourself, what is the flow that I expect to happen? Because that way, you know whether you're seeing the right type of action or not. And if you don't think you're seeing the right type of action, you don't need to trade, you don't need to participate in that moment. We'll wrap it up there and we'll start to move on to the other aspects, beginning first up with absorption, how to interpret it, what it's showing you, how to trade around it.